Okay, I'll be back. So I was saying that having done the initial information, the task is you come to the income statement and you begin with the lines below the other line of surplus before interest and tax. Any item that fall below that is supposed to be adjusted. So in this case, the first culprit was the finance cost. Okay, but once you read the finance cost, supposed to check if it has anything like opening and closing balances. If it doesn't have the kind I was asking, just post it the way it is. You say less finance cost 16,000. Okay, and operating activities. But if it has like it is now, it's supposed to draw the T account. Okay, T account of finance costs. Or is it sorry interest payables, which is the same as finance costs. Okay, interest payable account, and then pass the opening balance and the closing balances accordingly. Okay, it is a liability, so the opening balance is on the credit side and the closing balance is on the debit side. Okay, and the amounts are for opening balance is 4,000. Closing balance is 9,200. Okay, then after that, you bring the what do you call it? Okay, just a moment. Then after that, you bring the figure in the income statement. Okay, so remember, if it's an expense there, means that it was debited. So you're supposed to credit it here. So when you come here, you say finance charges or finance costs for there, whatever you want to say. Okay, and it was 16,000 in the income statement. Okay, so you try to balance it off to confirm how much was actually paid as finance costs. This is 20. This is 20. And I get the difference between the two. That balancing figure is what you call the finance cost paid. Finance cost or interest cost paid. This is the balancing figure. So this figure here is what you take under your operating activities. Operating activities here. Okay, then you say finance costs paid. It's usually the last line. Finance costs and interest, and taxes paid should be the last line under operating activities. Okay, so you bring here 10. It was paid, so it's negative 10,800. It was paid. Okay, so you're done. Remember, taxes were not there, so nothing to adjust for. So after that, that means officially you finished your income statement. You now go to the balance sheet. Okay, the balance sheet, what you have there is current assets. So when you have current assets and current liabilities, we're talking about working capital. So changes in working capital, we take them under operating activities. So when we start, therefore, we have cash and cash equivalents. These are balances. In our pro forma, they come down this side. Okay. At the end, you bring cash equivalents. At the beginning of the year, you got it balance brought down. The opening balance comes here. So opening balance is given as 6,400. Then the closing balance comes here, the last line. This case was given as 9,000. Okay, so you bring them there. Don't be shy to bring them there. Okay. All right. Then we continue. The next line under your balance sheet is revenues. Now revenues, they are increasing. So you come here under your operating activities, and you say changes working capital. Then you say increase receivables. Okay. They're increasing from 48 to 76. Okay, so how much is that? That is 76,000. It's 48,000. Okay, an increase in receivables means that your debtors are not paying you. So if they're not paying you, that's not good for cash, and hence this should be a negative. Okay, so the answer should be negative. Okay, then we go to the next item, which is inventory. Inventory is still working capital, and for it, it is reducing. So you say decrease inventory or stock. Okay, it is decreasing to 40 from 78. Okay, for this one, for it to be a cash inflow, because when your inventory is reducing, presume that people are paying you. Okay, and 38. Then the next thing is the next item is what? Is portfolio in investment. Portfolio in investment is not changing. So because it's not changing, it's not changes in working capital. So just chill. Okay, I have some people think that whenever they talk about investment, it's supposed to be an equivalent as long as it's under current assets. And I'm saying it's not the case. Okay, so unless they've added the word short investments, don't assume. So it's supposed to be changing in working capital, but it's not changing. So it is zero, so we ignore it. Then you go to the next thing, non-current assets. We already looked at those. We drew the T accounts, we saw the changes that happened. Then you go to current liabilities. You have payables. Okay, the payables are reducing. So you come here and say decrease payables. Okay, they're decreasing to 10,000 from 75,600. Okay, and whenever liabilities are decreasing, it means that you're paying, isn't it? So if you're paying, then money is what? Is reducing automatically, hence negative. Okay, then you continue. You have interest payable. We drew a T account and we saw the changes. So we don't have to do it again. Then you go to non-current liabilities. Non-current liabilities, if there are changes in non-current liabilities, they fall under financing activities. I hope you know that. That changes in equity or capital and changes in long-term liabilities or non-current liabilities, they fall under financing activities. Hence, in this case, it was increasing, meaning that we acquired another loan. Okay, hence acquired loan or a long-term loan. That's why our money increased from 41,600 to 92,000. Okay, couldn't have increased if you didn't get another loan. So hence, okay. So whenever loan increases, of course, money is increasing. That is good for cash. Money is increasing in our pockets. Okay, it is 15. Okay, this dividend, I forgot to put a negative. Dividend paid, because they are paid, it's a cash flow. Okay, money is moving out. Okay, we continue. Then after non-current liabilities, we go to capital. Okay, here's then capital contributed by government. Okay, so it increased. When so capital increases, we're saying we have acquired capital. Okay, since under financing, it's acquired capital. How much was it? We had 80 and now it's 90. No, it's actually 60. We had 60. Sorry, it's now 60. So meaning that there's an increase of 10,000. Okay. And because it's capital, if it's increasing, then our cash is increasing, which is good. Then accumulated surplus, we already looked at it. Do as you account, determine the dividend. And then you're done. Total equity and liabilities, that's just a total, so we don't need to use it. So after that, after dealing with all the information, then you just come and add and subtract accordingly. Okay, so when I have these, therefore, what I have here as my amount before I remove my working capital is that when I bring the working capital changes, okay, arrangement doesn't matter really. Okay, working capital changes, if I bring them, what I will get after adding working capital changes is that figure. Okay, so that's figure. Then on this one, I want to remove finance costs. So when I add that, therefore, I'll get 10, 100. Okay, then I bring these amounts from capital investment. The way they are is the way you add them. Okay, it's a negative. Then I bring these ones also. Ones from financing activities. Okay, it's still negative. So when I add those, when I add what I got from operating activities to investing and financing, I have a positive 2,600. So it is, if it's positive, then it's increase. Then you say increase net cash flows. Okay. So this figure here, the increase, is supposed to be added on the opening balance to come up with the closing. Okay. So if I may just prove that I'm right, is this increase, I add this, I'll get 9,000. Okay. You don't have to prove it in exam just for pressure reasons. You don't have to do that. Just chill. Okay. So guys, that is how we do the indirect method cash flows. So we're going to look at the indirect method. If you don't have any questions here. Any questions so far? Because if there are no questions, then we're going to do indirect. Okay, so I'm not seeing anyone typing. So for the indirect method, what happens is these things are almost the same, but okay, I want to pass the balance as you see. Okay, the format is the same. That is financing, cash flows from investing, and cash flows from operating. Okay, but what changes is that now when you're beginning, you don't start with obtaining that thing of profit before interest and tax. You don't need it in direct method, but rather you begin with additional information. Okay, now with additional information, it was giving us disposal. Okay, and these are the entries. Disposal, you draw your asset accounts, okay, and accumulated account and the disposal account. And then you pass the balances. So I don't want to repeat that part unless you have any questions on it. Okay, that you had an asset of 3.2 million. It was disposed of at 0.6 million and had accumulated depreciation of 2.4 million. Okay, so this is the information. The same thing. Opening balance is zero and closing is zero. So just bring them the figures, pass the entries, and we are here. Okay, that's the first part. So of course, the first part tells you that there's gain or loss on disposal. Now, if you read a statement, we had a loss of 200, yes, but our statement here it says that the resulting loss has been included in other expenses. Okay, what does that mean? It means that under our expenses, we have a non-cash flow transaction of 200 in other expenses. So if I go to my income statement, therefore, and look at it here, other expenses, loss, it is 200. Here we know that this loss is not going to be included in our books or in the income statement because this direct method only deals with cash transactions. So since this entire amount is a non-cash transaction, I don't need to do adjustments. I just eliminate it. I don't include it. Alternatively, you can include it by saying you can include it by saying that you come under operating activities, then you say under my expenditure or expenses. Under my expenditure. Okay, I have other expenses. How much? It was 200. But how much is not cash? It is still 200. So giving you 0. So I wouldn't have included it there if it were me. Okay, but maybe to show the working, we want to put it like that. Okay, direct method only shows cash transactions. So once you're done with that, let's go to note 2. Note 2 says dividend. Once it talks about the dividend, automatically you have to draw the T account of accumulated surplus to determine how much was declared and then later how much was paid. So this is my account, accumulated surplus T account. Bring the opening balances as usual, and then pass the surplus for there. Okay, balance off to determine how much dividend was declared. Okay, then look through the balance sheet to confirm if you had anything like dividend receivable or dividend payable. Because if you had it, then this is to be dividend paid, but rather dividend declared. And for it to determine dividend paid, you're supposed to draw the T account of the dividend payable or receivable, pass the opening balance and the closing balance, then pass this transaction, balance it off. In balancing it off, the balance that you get is the dividend that was actually paid, right? So in this case, we are lucky, we're not giving that stuff. So this is the same as paid. Hence, we come here under our financing activities and we say dividend paid was 84,000. Right? So then you're done. Then what happens is, remember we are done with additional information now. So you come and balance off all your T accounts first before you go to the balance sheet and the income statement. So when I come to my asset register, of course, I'll balance off and I find that I have a purchase of 600, not yet recorded. So you come here, step and say purchase of non-current asset. It was 76, so it's a purchase negative. Okay. Then what else? Yes, accumulated depreciation. When you balance off, you'll find that the depreciation for there is 18,000, indeed, as it was in the income statement. And I'm saying in direct method, whatever is non-cash flow, we don't include it. So depreciation is a non-cash flow, so we don't input it in our operating activities, as long as we don't contribute anything. Okay. Although that we can still say depreciation, like you've been doing depreciation, is 18,000 in the income statement, but again the real depreciation was 18,000 still. Okay, then you have 0. So these lines are really useless. They don't get you marks, and these ones under direct method, because once you compute here, you shall know that you have computed. Hence, all right. Okay, but that notwithstanding, so you're done with additional information. So you now go to your statements. Let me just take you back to remind you. Okay, all that you have done with, I've dealt with this part 1 and part 2. Now you go to your statements. You begin with the income statement. You move line by line from top to bottom. Taxes. Okay. Then you say, does it have anything like tax payable or tax accrued? You confirm with the balance sheet. The balance sheet, of course, not there regularly, so it's not there. So if it's not there, it means that this is the actual amount that was received, okay, as revenue. So under our income statement, you pass it the way it is. Okay, for all, let me just sample you some. So I'm saying under our revenues, cash flows, our revenues. Saying of taxes. You add the word received so that they know that actually there was money, not just revenue. Okay, how much was it? It was 1.22. So come here under our revenues and you say 1.22 600. 6,000. Okay, so you're done with that. And you go to the next line. The line says revenue from portfolio 20,000. Okay, does it have any adjustment? Is it do you have anything like accrued or prepaid? When you come this side, you have portfolio investment. But it's not saying it's accrued or prepaid. Okay, so you don't want to assume that it is the same income. Okay, this may be an investment, maybe both shares in a company. Okay, so therefore just treat it as though it is. So meaning it doesn't have any opening or closing balances. Hence 20. Come and say revenue revenues from portfolio investment. Okay, how much? It's 20,000. Yeah, go to the next line. Expenses now. You have wages and salaries. Okay, wages and salaries. Wages and salaries. Yes, because do you have anything there? Closing, sorry, accrued or prepaid? We don't have. Meaning this what was actually paid. It's 104, 123. Okay. Let me put negative because it was need paid. Yes. Okay. And I'm saying it was paid. Okay. Then next line we have supplies consumed. Okay, supplies consumed. I was saying these are the same as purchases. Okay, supplies consumed. These are the same as purchases, and purchases are affected by what you call the creditors account or payables account. So meaning that you're supposed to do the T account for payables. Okay, pass the balances and bring the consumed or the supplies consumed. Okay, so you come and say my T account. You can read all these others. So there's a new T account of payables. So you say payables or account payables or trade payables or current payables. Okay, that's opening balances. So the payable, the opening balance is 75,600. The closing balance is is my payable 10,000. Okay, so when you have consumables or goods consumed, you bring the figure here. By being this side under the income statement as an expense, it was debited. Which together when I know where I'm recorded, say supplies. How much? It was 38,000. And I added these. Trying the balance of have a balancing figure of 103,600. So you come under expenses, operating activities, and you say supplies consumed. Supplies consumed. Okay, it is a big figure, 103,600 now. Okay, get the difference. Then what next? The next line is depreciation. We already saw it was 18. Yes, it's 18, but it's in a cash flow, so we're not interested. Finance costs. Okay, finance costs. You come and say, does it have accrued? So it has. Okay, and it's an interest payable, right? And we're saying we pass the balances, including the charge in the income statement to confirm what was actually paid. So what was actually paid is 10,800. Come in, you said. It's among the last lines, like I already told you, it's finance cost paid. Okay, it's 10,800. Then other expenses, we already looked at it. Surplus for there, not interested. Okay, so you're done with the income statement. You move on to statement of financial position. Current assets. Okay, that's working capital. Come here and you say changes in working capital. Okay, changes we saw increase, decrease. Okay, up the thing. Did someone record or take pictures and help us with figures? If you did, can you get me figures for revenue and inventory? Someone wrote, kindly confirm with figures. If you didn't write, we're saying increase receivable is they're not paying us. Okay, so it's a negative. It's 48,000 minus 76,000. Okay, then decrease in inventory, it means that we are selling off, which is a good thing. It's positive, and 78,000. It's 40,000. Okay, then the next thing is portfolio investment. We're saying it didn't change, it's the same, so it can't come here. We saw non-current assets, we saw depreciation, we saw payables account. Okay, we also drew the T account for it and saw the changes, so we can't bring it again. Interest payable, we looked at it. Loan borrowing. Okay, borrowing, we said if it's long term, it's supposed to come under under financing activities. So under financing activities, loan here, say that the difference is what we take. We acquired another loan, that means, okay, and once you acquire a loan, that is money, so it's a good thing. So you're done with the loan. Then you go to equity. Capital also increased by 10. Okay, so money came in, so it's positive for cash. And then anything else? No. So you have finished the entire statements. So then lastly, you come and add and get the final answer. So for this one, I'll just add once. Get breakdowns. Okay, since I want to add this, okay, I think I'll need this one because it's on this side. Let me bring this on this side. So they only add once. It won't work. Total for this side from operating activities. Saying this whole thing. Okay, it is that. Then on that we add these others to come up with increase or decrease in cash flows. You add net cash flows from operating, then you investing, then finally financing. Okay, and here you have 200. Okay, I wonder why I got the difference now. Where am I wrong? Can be done. It's supposed to be 600, is it? Something like that. I think I made an error somewhere, but I'm not going to look for it. So guys, that is how we do indirect method. Any questions as we wind up? Because the official have finished a third day. So they say in Uganda. Okay, so guys, if there are no questions, I want to wish you good luck tomorrow. Okay, try to do simple numbers if you're going to practice these computations, simple numbers, so that boosts your what? Boosts your improvement, your confidence. Sorry, what? Pardon on revenues from portfolio. We're saying they're 20,000. Okay, why? Because we're saying, if I'm sure the question again. Here, revenues from portfolio is not the same as portfolio investment. They're not the same. Okay, it's what we call accrued revenues or incomes and prepaid incomes. Okay, but this one is portfolio investment, and I was saying that the two are different. Why? Because portfolio investment, you're saying it is more of like investing in shares or any asset, and then from it you expect revenues, and these are the revenues. So if the revenues were outstanding in any way or some were not received, would have a different account, a different lines showing maybe you have investment receivable, sorry, or you have revenue accrued or outstanding. That's when you do a T account for it, and then past 20 to confirm what was actually paid. Okay, so I hope I've answered you regarding revenue from portfolio. You didn't have any additional information in the statement, and because of that, I didn't have to get the account for it. That's why it's like that. All right. So guys, I already said, I want to wish you good luck in these papers. Shakira, any questions? Shamira, if there are no questions, kindly confirm so that we call it a night. Yeah. All right, no problem, no problem. No worries. Okay. All right. Also, thank you for attending. Okay. Mm.